Welcome to The Explainer. Today, we're unpacking a story that honestly reads less like a standard financial update and more like a high-stakes corporate thriller. We're looking at ConocoPhillips, one of the world's largest and most powerful independent energy producers. Right now, this legacy energy giant is standing at a massive crossroads. We're talking about record-breaking profits colliding with a sudden changing of the guard, all while the company places massive geopolitical bets and races against the clock on a multi-billion-dollar project in the freezing Alaskan wilderness. It's a fascinating pivot, and we're going to break down exactly what it means.
Okay, let's dive into this. Here's our roadmap for today. First, the Q2 earnings blowout, then a major leadership transition, followed by their strategic Middle East expansion, the valuation debate on Wall Street, and finally, key catalysts for the road ahead.
Section 1. The Q2 2026 earnings blowout, focusing on financial health and shareholder returns.
So, to really understand where ConocoPhillips is heading, we have to look back at their August 6th financial results. 128%. That is the staggering, jaw-dropping percentage by which their Q2 2026 adjusted earnings per share crushed the exact same period just 1 year prior.
To put that into perspective, last year's Q2 EPS was sitting at $1.42. Coming into this quarter, Wall Street consensus was looking for a respectable $2.96, but the actual reported EPS, $3.24. This massive beat over consensus estimates proves that, right now, the company is firing on absolutely all cylinders.
So what exactly fueled this massive revenue beat? Well, first, higher realized prices jumped 36% to $62.33 a barrel of oil equivalent. Second, they hit record production in the Permian Basin, which is their flagship U.S. asset. And third, just incredibly strong operational execution, generating $9.32 billion in EBITDA. But here's what it means for the retail investor's pocket. Look at how they're deploying that cash: $3 billion in total distributions, an 84-cent quarterly dividend, and crucially, $2 billion in share repurchases. That's double the previous quarter. They are aggressively rewarding shareholders.
Moving on to Section 2. Changing the guard, the leadership pivot, and the Alaska Willow challenge.
Now, right as the company posts these spectacular numbers, they announce an abrupt, monumental pivot at the very top. After 14 years at the helm, CEO Ryan Lance is stepping down. Effective September 1st, 2026, former CFO Andy O'Brien takes over as CEO, and Connie Haynes-Welsh steps up as the new CFO. But looking out to 2029, this new leadership team is inheriting a massive legacy challenge, specifically a pledge made under the previous CEO to deliver a $7 billion increase in free cash flow.
And incoming CEO Andy O'Brien knows exactly what he's up against. He explicitly stated, delivering Willow and the associated cost reduction program will be a hyper-focus. I really love this detail because it completely humanizes his immediate priorities. He isn't getting a honeymoon period here. He has to deliver on the absolute biggest project in their pipeline.
To understand the sheer scale and execution risk of this, the Willow project underpins nearly 75% of that entire free cash flow growth plan. We're talking about 600 million barrels of lifetime production. But it isn't cheap. The budget has actually been revised upward to between $8.5 and $9 billion. It's currently 50% complete, with first oil targeted for early 2029. This is literally a make-or-break multi-billion-dollar ticking clock in the Alaskan tundra that the new CEO absolutely has to get right.
Section 3. Pruning and growing. Middle East expansion and asset shedding.
So, while everyone is watching the CEO transition and the Alaskan ice, ConocoPhillips has been quietly executing some really aggressive geographical maneuvers. They call this their prune and grow strategy. Simply defined, it means they're disposing of non-core domestic assets to fund the acquisition of long-lived, low-cost international inventory. They've already hit their $5 billion disposition target ahead of schedule, which was completely bolstered by a $1.7 billion non-core lower 48 asset sale in July alone. Essentially, they're trimming the fat at home to bulk up abroad.
And abroad specifically means the Middle East. Securing conventional production here is a bold move. Over in Iraq, they're acquiring a massive 42% stake in BP's Kirkuk oil fields. In Syria, they signed an agreement to revive central gas fields, which is incredibly notable because it's the first major U.S. energy company deal with Damascus since the Civil War. Plus, this positioning gives them access to a U.S.-backed oil pipeline linking Iraq and Syria. It's undeniably a complex geopolitical region, but securing these strategic resources is a massive play.
By expanding into the Middle East, they're actively diversifying beyond U.S. shale. Why does this actually matter for the overall company? Because they're locking in low-cost, long-life conventional production. These assets have much lower decline rates than shale, providing long-term stability and access to growing regional energy demand. It's a calculated, strategic balance to their U.S. portfolio.
Section 4. The Valuation Debate. Wall Street's Consensus versus Premium Metrics.
Now, what's really interesting about this valuation debate is the tension it creates on Wall Street. When you combine massive earnings, a new CEO, and major global expansions, you naturally get a divided crowd. The bull case points to underappreciated low-cost inventory and massive growth catalysts like Willow and their LNG expansion, all combined with upside supply risks in the broader oil market. But the bears, they definitely push back. They argue the stock is currently trading at a premium valuation, specifically a 2.3 times forward price-to-sales ratio, which is well above the industry average. They also highlight the severe execution risks if Willow faces delays and point to a potential earnings moderation expected in 2027. So it's your classic battle of a premium price tag versus sheer growth momentum.
But how is Wall Street actually voting with their wallets? Well, major firms are issuing significant upgrades. Morgan Stanley moved to overweight with a $151 target. Jefferies, UBS, and Argus Research all rated a buy with targets in the 150s. Wells Fargo goes even higher with a buy rating and a $189 target. Across all 25 polled analysts, the average target sits at $144.08, which implies roughly a 10% upside from current trading levels.
And here is arguably the most striking piece of data in our entire explainer. Out of those 25 major analysts polled by S&P Global, there is a complete absence of a single sell rating. 0. You have 15 strong buys, 4 buys, 6 holds, and absolutely nobody telling you to dump the stock. Despite the premium valuation and the executive transition, institutional consensus remains overwhelmingly confident.
Section 5. The Multi-Year Story. Key milestones and final thoughts.
We've thrown a lot of data and corporate strategy at you today, so how do all these catalysts weave together to define the stock's future trajectory? Right now, in September 2026, all eyes are on Andy O'Brien's first moves as CEO. By late 2026, watch for those massive Middle East deals in Iraq and Syria to officially close. Moving into 2027, their expanded LNG projects are expected to start contributing heavily to the bottom line. And finally, the crown jewel, early 2029. That's the target for first oil at the Willow project in Alaska. Which leaves us with one central, provocative question. Can new CEO Andy O'Brien execute this massive, complex Willow project and actually deliver that promised $7 billion free cash flow increase by 2029? It's a towering challenge for a newly minted executive, but if recent numbers are any indication, he's taking the wheel of a remarkably well-oiled machine. Thank you so much for joining me for this explainer. Keep an eye on those catalysts, keep learning, and we'll see you next time.